Hello, my name is Stephen Bates, CEO of QLab Invest. In a previous video, I've talked about the psychological traps in investing and how to avoid them. The resulting active portfolio had low risk and provided good returns and peace of mind to stay invested through the market cycle. However, some investors would still like more return. In the next 5 minutes, I will explain how to achieve higher returns without greatly increasing the risk. There is a Chinese proverb that says the best time to plant a tree was 20 years ago, and the second best time is today. Perhaps one can say the same thing about equity investing. Over the last 20 years, the S&P 500 total return was around 10% per year, versus 3% for US dollar cash and about 2% inflation. However, these returns came with a good deal of stress. Volatility was 19%, and there were 2 periods of drawdowns of around minus 50%. And we have learned from behavioural finance research that such losses often cause investors to panic, exit their positions, and then miss the recovery, failing to pick up the average returns over time. So what are the options now for those still searching for high equity-like returns, but who fear the equity volatility and drawdown risk? I believe the answer is to plant that tree today and invest in a portfolio that contains equities, but also other assets, and make sure there is a robust risk management process in place to actively manage the equity exposure. The aim is to capture the upside of equities, but avoid the worst of the downside. Previously, I showed a multi-asset portfolio that benefited from active asset allocation to create highly convex or asymmetric returns. But how can one now increase the return of such a portfolio so it is able to keep up with equity market returns? Surprisingly, the answer isn't to create an equity-only version of the portfolio, but rather to increase overall exposure to this well-behaved portfolio through the modest use of leverage. The very concept of leverage can make people nervous. However, this needn't be the case. Firstly, leverage should be capped so that the maximum risk is controlled. Given the underlying portfolio I will use has a volatility of 6%, I have set the cap to times 3. So that the risk in general should be no more than equity markets. Given the maximum exposure to equities in the underlying portfolio is 35%, then times 3 exposure would only mean at most 105% equities. Secondly, the leverage should be not static, but dynamic. In times of higher market risk or market decline, the leverage should be reduced, or even turned off completely, in order to protect the downside. How can this be done? This chart shows the result of a process that dynamically varies the leverage over time. The S&P 500 performance is overlaid to remind you of the market conditions at the time. The level of leverage is set to a maximum of times 3 unless there is high short-term risk in the markets or the market is in decline, in which case the leverage is reduced quickly, often to a value of 1, which is no leverage. The process makes use of the short-term predictability and risk. That is, if risk was recently high, it is likely to stay high for a while before declining again. You can clearly see that during bear markets and during times of high risk, the leverage is quickly reduced. What does that do to the volatility of the strategy? Remember I said the risk of the underlying strategy was 6% volatility, so leveraging will create higher risk than that. Here is the 1-year rolling volatility of the leverage strategy, which is called QLab Dynamic Allocation, shown in black. You can see the volatility varies roughly between 10% and 15%. The 1-year volatility of the S&P 500 is shown for comparison. It varies from about 10% to over 40% and is far from stable. The reason the dynamic leverage strategy has more stable risk is that firstly, the leverage is systematically reduced in times of crisis. And secondly, the underlying asset allocation is also going more defensive at the same time. Actually, you can also see that when the risk of the S&P 500 is increasing, the risk of the leverage strategy is actually decreasing due to the same 2 reasons. So in terms of volatility, the dynamically leveraged strategy is less risky than a pure equity investment, such as an ETF tracking the S&P 500. We know that volatility is only part of the risk equation. Drawdown risk, or loss of capital, is far more tangible to most people, and the reason they often panic and sell out of the market. This chart shows the drawdowns of the dynamic leverage strategy in black. The drawdowns of the S&P 500 are shown in red. The fact that the leverage is dynamic and the underlying asset allocation goes defensive at the same time reduces the drawdown risk dramatically. The maximum drawdown of the dynamic leverage strategy is about minus 13%, whilst for the S&P 500 it is minus 55%. This is why passive equity investing is tough on the emotions, and that there can be a psychological cost to investing in equities. If you were to panic and sell and not come back in at the right time, you will miss the recovery and not receive the average return potential. Here are the results on returns. Given there is some persistence in both risk and momentum, an active strategy can be highly effective at not only avoiding the worst drawdowns, but in capturing very good upside, even in excess of equity markets. So, isn't it time to plant that tree?